We're actually a multidisciplinary firm of lawyers and accountants, and we specialise in all forms of employee management, share incentives, employee share schemes, employee-owned companies. Within our field, we're quite well known, I think it's fair to say. One of the reasons for that is we're responsible for the leading textbook on the subject of employee share schemes. That's a massive 2-volume loose-leaf publication by Sweet and Maxwell. David Pett, of Pett Franklin, is a very active member of the Office of Tax Simplification, and behind the scenes he's been responsible for a lot of the changes to employee share schemes generally, which have been coming through that office and then through the Treasury. I've also been doing my bit, hopefully steering HMRC shares valuation in the right direction. So the aim of this webinar today is hopefully to give you a clear understanding of the benefits to your clients of providing management and employees tax-favoured share options called enterprise management incentives. So what is an EMI? Well, it's an option, typically an option to acquire shares by subscription in a company that qualifies for employees who are eligible. The rules of the game are set out basically in Schedule 5 of ITPA, and providing the conditions are met, the option can then be exercised and the shares acquired in a very tax-efficient manner. Whether or not shares can then be sold, of course, is a different matter and is a sort of commercial issue as to whether there is an exit. The option must be in writing, and it must state that it is granted under the EMI provisions. It must state the number, or at least the maximum number of shares which may be acquired. It must state the price, if there is any price, which is payable on exercise, and when and how the option may be exercised. It must state any conditions on which the exercise is conditional. The shares potentially can be restricted shares, but if they are, then you need to give details of those restrictions. The option itself, however, is not transferable except possibly on death. Now, a lot of what we'll be talking about today concerns income tax. However, before we get into all the details of that, I think it's very important to remember that there is another relief which is generally provided through EMI options, which is very valuable indeed. An employer company can, if it's providing it's independent, claim relief from corporation tax for the amount of an employee's share option gain. And sometimes that can be a very substantial relief indeed. Anyway, let's just focus on the income tax side of things now, of enterprise management incentives. The original legislation was introduced back in Finance Act 2000. And it, in fact, was one of the first examples of legislation produced by an independent government-approved advisory group. David Pett, who I mentioned earlier with Pett Franklin, was a key member of that group back in 2000, and probably can claim quite a lot of the responsibility for the original idea of EMI. EMI options are primarily aimed at small, independent, hopefully high-growth companies. The idea of the government was that it wanted to encourage those sort of businesses to be able to recruit good people, businesses that might not have enough cash to pay top salaries. They could at least offer employees a slice of the action through share options, and those options being made particularly tax efficient. Unlike a lot of other inland revenue schemes like SAYE, there's no prior approval required. You have to satisfy yourself that you're complying with the legislation, and then you register the options with the Inland Revenue within 92 days of the date of grant. EMIs have to be structured as share options, but within that limitation there's a lot of commercial flexibility regarding the exercise price you can set and when the options can be exercised. But if the options are going to be exercised at all, they must be exercised within 10 years. So what's the tax position? Well, basically on the grant of the option, there should be no income tax or national insurance. More importantly, perhaps, there should be no income tax or national insurance on the growth in the market value between grant and exercise. Now, you may have heard that you can lose the benefit of EMI options through what is known as a disqualifying event after the grant takes place. That, for example, could be a takeover or the employee leaving the company. However, this isn't necessarily catastrophic because relief from income tax and national insurance is still accrued. It's still provided on the accrued gain up to the point of the disqualifying event. And in fact, there can be no loss at all of relief if the option is exercised within 40 days of the disqualifying event. That's actually being relaxed, hopefully, as a result of the forthcoming Finance Act to 90 days. One thing to note is that if the shares are acquired on the exercise of an EMI option are restricted shares, and the exercise price is the initial actual market value of the shares, then the difference between initial unrestricted and initial actual market value, the effect of the restriction, actually falls out of charge. There is a purpose test for EMI. You must be granting these options for commercial reasons, not the avoidance of tax. Now that is a bit of an odd situation because of course EMI is designed to avoid tax, but perfectly legitimately. HMR practice in this area so far has been fairly relaxed in its interpretation of that clause. Now, you can set the exercise price of the option at less than market value. You can even set it at nil, but do remember if that's the case, then and you're issuing new shares, someone will have to pay the nominal value for those newly issued shares. If you do set the exercise price of the option at less than market value, then that discount at grant is charged to income tax at the time of exercise. So, if you grant an option at market value and there isn't a disqualifying event, there shouldn't really be an income tax charge on exercise. However, there are circumstances when you can have an income tax on exercise, and I've summarised these in the following 2 slides. Now, the first one considers a market value option where there's no disqualifying event. Then we look at a discounted option with without a disqualifying event. Further on, we look at market value options with disqualifying events occurring more than 40 days before exercise, and then one where it occurs, disqualifying event, and exercise occurs after 40 days. It all gets a little bit beady. I suggest when you've got a moment, you look at those slides carefully to get the picture. But the essential idea is, yes, you can have income tax charges on exercise, but if providing the market value options and there isn't a disqualifying event, you should be outside of this situation. So there's no income tax, but there is CGT. That's payable on the sale of the shares on the gain. Now, that used to be at the rate of 28%, like the normal rate for capital gains tax for higher rate taxpayers, or 18% for basic rate taxpayers. However, in last year's budget, entrepreneurs relief, i.e. the reduced rate of 10%, was introduced for EMI options, providing the shares were held by the employee for 1 year and all the other ERM conditions were satisfied, except the need to hold 5%. So if you got your shares through EMI, you didn't have to have 5%. Any holding, however small, would qualify for entrepreneurs relief. The one drawback with the change last year, or the main drawback with the change last year, was the requirement that the shares had to have been held, the actual shares after exercise had to have been held for a year before you could sell them and get entrepreneurs relief. Now that's obviously not ideal in situations where people exercise the options and then try and sell them quite quickly, potentially in an exit situation. And the good news is that that 1 year condition is being removed as a result of the current Finance Act, or the proposed Finance Act for 2013. There is still a wee bit of a problem, however, that you need to be aware of. If you grant if you exercise EMI options and you acquire shares that therefore qualify for entrepreneurs relief, and then before selling those shares you swap them, exchange them into other shares, then there's a weakness in the legislation, which means that you lose the benefit of entrepreneurs relief for the shares that you've exchanged into. People are trying to get that changed. We'll see if that happens. There are conditions that the companies must meet in order for the options to qualify as EMI. The company, or if it's a group, must have fewer than 250 full-time equivalent employees. The EMI company or group must have gross assets of less than 30 million. Now, if you're dealing with a group situation, what you're concerned with is the sum of the gross assets of each company. You don't look at the consolidated accounts. That sounds a bit tautologous, but there is a difference. Because you don't look at the consolidated accounts but aggregate up the individual companies, consolidation adjustments don't figure within the 30 million, and that can be quite important. The EMI company must be independent. Now what that means is it can't be controlled by another corporate body. If it is, you can't grant EMI options. And that is a problem actually for many companies which have private equity backing, where there is a controlling private equity corporate investor. They unfortunately can't qualify for EMI options. But if you've got a controller who's an individual person, then that's not a problem. There must also be no arrangements in place for the loss of that independent status. The company or the business also must not carry out a disqualifying activity. You can, perhaps surprisingly, grant EMI options over shares in an overseas company, but at least one company in the group must have a permanent establishment in the UK. There are some other conditions. If you've got a group of companies, there are some quite beady rules concerning the subsidiaries that those companies have, which you have to comply with. If you've got a property managing subsidiary within the group, then that needs to be at least 90% owned. And again, there must be no arrangements in existence which could cause the independence or the subsidiary tests to fail. One area to be careful of concerns preemption rights in investment or funding agreements, or even straightforward bank loans. Situations we're thinking about are where there's a provision, perhaps in a meltdown, for the investor to acquire control of the company. So in those situations, potentially EMI isn't available. What about that trading activities requirement we mentioned earlier? Well, the basic point is that the activities of the company or the group must not consist as to a substantial part, i.e. that's normally thought to be about 20% of excluded activities. So you can have some excluded activities, but there mustn't be more than 20% of the whole. They're the sort of things that you might expect. You know, dealings in land, banking, insurance. Lawyers and accountants, unfortunately, can't qualify, although independent tax advisors probably can. There's a restriction on leasing or the receipt of royalties, except where the royalties are as a result of the generation of your own intellectual property. That's okay, but if you're getting royalties from things that you didn't generate, then this can be troublesome. And indeed, some IT companies that, of course, generate revenue through royalties can be tripped up by this restriction. Forestry is another interesting one. Presumably that means you're restricted if you try and run a business consisting of the growing and maintenance of trees. But what about those companies that chop down trees and then turn them into wood chipping? Is that forestry? The EU introduced some rather annoying restrictions that prevent shipbuilding or coal or steel production qualifying from EMI. There are conditions attached with the employees. The individual must be an employee of the EMI company or one of its qualifying subsidiaries. It isn't sufficient just to be an officer of the company. They must be committed to working for the company for at least 25 hours per week, or at least 75% of their total working time is devoted to the EMI company. So you can be a part-timer and qualify for EMI options, but the great majority, at least 75% of the work that you do, must be for the company that grants you EMI options. You can't have a material interest in the company and qualify for EMI options. Material interest is defined as 30% for EMI. It's a measure that you look at the date of grant, not exercise. And there isn't a look back. So if subsequently you do become a material shareholder, that's not necessarily a problem. It's at the date of grant. In counting the 30%, yes, you look at associates, but brothers and sisters don't count as associates. Something else that's quite helpful is that any EMI options or shares acquired through EMI are left out of account. That's different from other options that you might be granted. In those cases, you do have to take those possible options into account in working out whether you've got a material interest, but of course you can also gross up the number of shares as a result. Also, be careful if there's an EBT. Now, sometimes trust shares can be disregarded, but not always. It used to be the case that the individual was limited to £100,000 worth of shares under option at the date of grant. That's been lifted over the last few years. So it's now really 250,000, which is, a lot of value that can be delivered through EMI. There's an overall limit now for all the participants of 3 million. It used to be the case originally with EMI that it was restricted to a few individuals, but you can, and many companies do, grant options to all employees, or at least some of them. One of the beauties of EMIs is it's discretionary. The company can choose exactly who receives the options. Let us now give an illustration of how EMI might work out in terms of numbers. Let's imagine we're looking at a £50,000 gain. Now suppose you try to deliver that gain through conventional options, unapproved options, or a cash bonus. You'd have taxable income, in that case, of £50,000. Let's assume the individual is paying the new top rate of 45% plus an NI. After tax, they'll be left with £26,500. But the employer would also be responsible for paying national insurance, another £6,900. Now, compare that if the same value had been delivered to employees through a EMI option. There you'd be looking at a capital gain, not income tax, at 50,000. You'd have the nil rate band, presumably, to use, bringing the taxable gain down below. Assuming entrepreneur's relief is available, the actual tax is only £3,940. So the employee is actually left with £46,000 after tax, almost £20,000 more than if they received it through a cash bonus or conventional options. And the company also saves the national insurance. It's those numbers, really, that make the case for EMI so compelling. And the reason why EMI, if you can do it, you should do it. But remember, it's even better than this, because there's that corporation tax relief I mentioned earlier. The company may well be able to claim £50,000 of corporation tax relief, and all with no outflow of cash if new shares are issued. Another thing to remember is that 250,000 limit, we'll come on to valuation in a bit more detail later on, could be after a 75% discount for minority interest. So we're talking about potentially putting £100,000, £1 million worth of shares under option at whole company value under EMI. I've given an example of how it works out for a top rate taxpayer, but remember, a basic rate taxpayer also benefits. They would be paying tax if they didn't have EMI at 20% income tax plus 12% MICs. And of course, if they're losing out through the withdrawal, the taxation of family allowances, their marginal rate of tax may be very much higher than 47%. You might say, okay, the reason it's so beneficial from an EMI point of view is that there's a capital gains tax treatment. And I could achieve a capital gains tax treatment for my employees simply by awarding them free shares anyway, without going through the business of granting them options and then having them exercised. So why don't I just invite employees to subscribe to shares at market value? Well, you could do that. They would have to pay for the shares at market value, because if you didn't, there would be an income tax charge on the market value of the shares at grant. But remember, compared with awarding shares, that growth over the option period gives rise to potential CT relief. Furthermore, if the shares are restricted, then any difference between the initial actual market value and the initial unrestricted market value falls out of charge to tax. You don't get that treatment if you just award shares. And there's some deeply practical reasons why you might want to give options. If the employee leaves, then unless you've structured it so that he's allowed to keep the options and exercise it, the option simply lapses. You don't get any shareholder dilution until the point of exercise. And in the meantime, since there are no shares, you don't have concerns over minority interest. So there's a lot of practical advantages in the use of options. Let's go back to some of the requirements for EMI. We've said before it has to be a written option contract, which is an enforceable contract to acquire shares in a qualifying company. Now that contract either usually takes the form of a long-form bilateral contract setting out all the terms, or it takes the form of a set of rules with a short-form certificate and an agreement to be bound by those rules. Now, if you're awarding options to a number of people at the same time, it may well be simplest to grant the options in the form of a set of rules and a short-form certificate. By contrast, if you're making a single award to an individual, a bilateral contract may be simplest. And indeed, if you've got a situation where you're making a number of awards to individuals at the same time, but on different terms, which is possible, then you probably want to, again, go down the bilateral route rather than have a set of rules. It all depends on circumstance. Now, the grantor can be the company, but it doesn't have to be. An existing shareholder or an EBT can grant the options. And the employer company can still get the CT relief, whoever grants the options and provides the shares. As I said, you don't have to get the scheme approved by the Inland Revenue in advance. You do have to be satisfied that it meets the conditions, however, because it can be withdrawn later if the Inland Revenue find that it hasn't complied with the rules. But you do have to register the awards with HMRC. Now, the time limit for that is fairly generous. You've got 92 days to register it using a form called EMI1. That has to be completed and signed by both the employer company and the employee. 92 days seems like a long time. It's amazing, however, how quickly that goes. It's really advisable to get these options registered as quickly as possible after grant, because I've seen many tragic cases of people who failed to do that, tried to get the things registered later than 92 days, and the Inland Revenue simply wouldn't do it. So time it's advisable to get on with that. There's also an annual requirement on the to report EMI options to the Revenue on something called Form 40. The address to which you send the EMI forms changed from April last year. It's now in Nottingham. A few thoughts about how you might apply EMI options in private companies. One situation that often occurs are exit-only options. Here the idea is the option is only exercisable upon the sale or change of control or an admission to the stock market of the company. And generally what happens then is if the employee leaves for any reason, the option lapses. Sometimes he's allowed to retain or hold or part of it until an exit occurs. But you can keep it very simple and say, if you're not there, you don't keep the option. There are other ways of putting conditions into options. You can have a vesting schedule that says the option, the right to exercise the option accrues over a period of time. So maybe, say, after 3 or 4 years or whatever you specify, the options then become exercisable, maybe regardless of whether there's then an exit event or not. You can also put performance conditions to the options, so that if a performance condition, either personal or corporate, isn't satisfied, the options lapse at that time. The Articles of Association can be quite important in an EMI option. If the option is capable of being exercised before an exit, then the Articles of Association do need to be checked to ensure they make proper provisions for protecting against the disposal to a third party by the employee shareholder. Arrangements need to be in place for compulsory buybacks, possibly at market value for good leavers or at nominal value for bad leavers. You probably want to put in provisions to allow transfers to an employee benefit trust, and make sure there are the appropriate drag-along and tag-along rights in the event of a takeover. You do need to be aware that there can be company law problems if the articles are changed after the option has been granted. Now, if this is an important change and it affects the shares, that might be enough to trigger off one of these disqualifying events we've talked about. There's also a New Zealand case recently where options were changed, the rights under articles were changed, and the option holders brought a claim for loss on the company as a result. So, an area where some care is needed. I've mentioned share valuation. Now, one of the actual attractions of EMI options is that you can, if you want to, you don't have to, but you can, if you want to, go to the Inland Revenue in advance before you make the awards and seek agreement from the Inland Revenue as to the market value of the shares. Actually, you normally ask for 2 valuations. You ask for the unrestricted market value and the actual market value. The actual market value is the value of the shares, all factors considered. The unrestricted value is the actual market value, but disregarding the impact on the value of any restrictions that might be placed on the shares. The unrestricted market value is the one that you use for the limits, like the £250,000 per person, while the AMV is the one that determines whether you've granted an option at market value or not, and whether there might be any income tax on exercise as a result of discounts. Now, if we're talking about unquoted companies where the number of shares involved is relatively small and there's no imminent prospect of a disposal of the shares, normally at least 2 to 3 years, then very often it's possible to agree within the Inland Revenue very substantial discounts for the shares compared with the whole company value. Discounts of over 70% are not unusual. Now, the Inland Revenue actually is in the process at the moment of producing new detailed guidance on the valuation of EMI options. That's currently out for consultation with a small group I belong to, and hopefully the Inland Revenue will publish those later this year. They're likely to be very helpful if they are published in their current form. When it comes to EMI valuations, the Inland Revenue Share Valuation Department operates what they call a risk-based approach. Because, in their view, the companies concerned are relatively small, they regard EMIs as relatively low risk in general compared with some of the other valuations they do. The flip side of that is that they are trying to restrict the use of valuation agreements for EMI purely to EMI valuations. If any of you have done EMI valuations recently, you would have seen in the letter from the Inland Revenue saying this valuation is solely for the purposes of EMI and cannot be relied upon for any other purpose, or something like that. Of course, actually, how can that possibly be the case? Because, if a value is right for one part of the Taxes Act, how can a different value apply for the same shares for a different part of the Taxes Act? I think the Inland Revenue know they're on weak ground, but are just trying to make a point. I just always want to remind people, of course, that corporation tax relief is normally available for an amount equal to the gain realised at exercise of the EMI option, but do beware, you can lose that relief if the company loses its independence before the option is exercised. So, before we wrap up, I just thought I'd run through a few of the circumstances where EMI options might be used. Someone once actually described EMIs as a solution looking for a problem, and actually their application is only restricted by our imagination. But one of the more obvious circumstances where one might use it is where one is seeking to recruit a new manager or a new employee. The idea here is give them options rather than shares for at least a probationary period. So that avoids any problems of a buyback if they leave early and the employment doesn't work out. You might want to make the options so that they only vest on exit. That has many merits of simplicity and focusing people on the growth of the business. Remember, if you do manage to grant options several years in advance of any exit or potential exit, you're likely to get a substantial discount, which means that even if the company doesn't grow in value between the grant and exit, the employee will enjoy a substantial uplift and gain that is subject to the EMI taxation regime. Another thought might be to issue EMI options which are immediately exercisable. Why might you do that? Well, suppose you're planning to award shares to employees, but they were going to get less than 5%. If you just do that, then of course they don't qualify for entrepreneurs relief. But if you grant them EMI options, which they then immediately exercise, then they should qualify for ER relief, even though they're less than 5% holdings. Always remember that CT relief for options. You might be worth thinking about how you structure the ownership of a group to combine shares with EMI options to get a CT deduction. Another circumstances where EMI can be useful is in what I call late sale planning. Let's imagine the business is on the runway to being sold. Staff have been promised a bonus linked to the sale of the business. Now, rather than pay it out in cash, where it will be subject to all that tax in the form of income tax and national insurance, etc., why not try and structure the award as an EMI option? Now, providing you think about this and do it early enough for there not to be arrangements actually in place, then it should be possible to grant EMI options, and it should be possible to agree with the Inland Revenue at least a meaningful discount. It won't be as big, obviously, because there's a prospect of a disposal, but you might well be able to negotiate at least a 15 to 20% discount. So maybe a fifth of the proceeds will be taxed as capital rather than as income. Worth doing. But there's lots of other ideas. Why not grant EMI options instead of pay rises or instead of bonuses? How can we help? Well, we're always happy to have an initial discussion at no cost. So if you've got an idea or you've got clients who might be interested, just give us a ring or send us an email, and we'll be happy to have an initial discussion with you to see whether EMIs might be sensible. If we think they are, then the next stage really is to make sure that the company actually qualifies and there aren't any sort of problems with actually granting EMI options. Sometimes with things like the qualification conditions, whether the company qualifies or not, it is actually possible to go to the Inland Revenue in advance and get a clearance, and that can be very useful. The core of implementing a EMI scheme involves producing the documentation. As I said, the Inland Revenue don't pre-approve this, so it is important that this is right and it doesn't have weaknesses, and that's where we come in as specialists. We can also help with all of the other company law issues that are necessary, drafting resolutions, possibly amending articles if that's necessary. If you want a share valuation done, don't have to, but if it's a good idea because it gives certainty, then we can help with that as well. We do a lot of share valuations and, as I said, have a lot of experience of the way the Inland Revenue looks at them. Then there's the process of actually granting the options, dealing with the Inland Revenue, keeping records. We can help with that as well. Those are our contact details, telephone and email, and if I may, I think that's probably as far as I intend to go. Perhaps we could have some questions now.